Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Matt Markiewicz, Head of Product and Capital Markets at Tradr ETFs. And we're talking about Tradr's Calander reset ETFs. These are leveraged ETFs that can be used by slightly longer term investors, unlike popular leveraged ETFs that are supposed to be used for shorter time frame only because of the daily reset. Matt, welcome back. Great to have you on the show.
Great to be back again, Nina. It's been a while.
It has been. So let's talk about these leveraged ETFs, but let's start with the problem with the popular leveraged ETFs. And these leveraged ETFs have been around for a while. They were introduced in 2006. And some of them have been immensely popular. For example, the 3X QQQ ETF, TQQQ by ProShares, that has about 23 billion in assets. And in fact, now we have over 200 products in so many different flavors. We have 2X and 3X funds that track a wide range of assets, from broad market indexes to sector indexes and other ETFs. And more recently, some of the ETFs, leveraged ETFs that track popular individual stocks, particularly the hot ones like Nvidia and Tesla. They have been quite popular with investors. And I think regulators as well as ETF providers, they have done a commendable job trying to educate investors about the volatility drag. But to start off, could you explain to our listeners who may not be familiar with volatility drag, what is volatility drag and how does it impact the performance of leveraged ETFs?
Well, volatility drag is a phenomenon, Nina, whereby the leverage ETFs, because they reset their performance every single day. As you mentioned, there are over 200 leverage ETFs in the market, and they're all generally built the same way. Because they do reset that performance at the end of every trading day, you are only, I won't even say guaranteed, but the ETF is only supposed to deliver a multiple of the day's performance of that underlying asset or single stock or index. Now, volatility drag refers to when you hold that ETF that's giving you daily leverage over a longer period of time, the path of that stock's movement, up 3 days, down 2 days, up 1 day, for instance, at the end of that 6 days, you may not get the leverage factor as stated in the fund's name. And that's because of that daily reset. So it's also a concept called path dependency, when you bought the ETF and when you sold it. And that path of the returns is going to be impacted by the daily volatility of that underlying asset or that reference asset. So the longer you hold it, the longer you open yourself up as an investor to that concept of volatility drag and run the risk, and a severe one at that, of your ultimate return not matching up with the leverage that the fund is offering for that single day.
So path dependency is very important. So particularly if the underlying security is volatile, then risks of underperformance that gets amplified. And I've heard from some of my friends that they have held NVDL for like 1 year, more than a year, and the CTF is up more than 500% this year, and that is more than 2x the gain in NVIDIA shares, and it is because Nvidia's stock has been like a rocket ship. But when the underlying security is volatile, then the underperformance risk is huge. In fact, Bloomberg Intelligence had pointed out that one of the 3x leveraged ETP that trades in Europe, and it tracks the very volatile MicroStrategy stock. And earlier this year, MicroStrategy was up more than 100%, but the 3x leverage ETP had plunged more than 80% due to this volatility decay. So we hear from people that they held this ETF for a year. Some people hold for a month or so. What have you seen? How long do investors usually hold these popular leveraged ETFs?
Well, it really depends on, for one, the leverage factor. So the 3x, the 3x leverage ETFs, of which only 2 ETF issuers in the US are allowed to, or they're grandfathered in at this point, offer such products. We see a much shorter holding period on the 3x levered products. For instance, you referenced TQQQ earlier. By my analysis, that has about a 7-day average hold, trading days. The SOXL, which is the 3-time semiconductor ETF, that has a 4-day hold on average. Now, transitioning to some of the 2X products, the more popular 2X products, and this was part of our analysis when we were looking at which products should we launch and where is the need in the marketplace. The SSO ETF, which is the 2 times S&P 500, the average hold there is 26 trading days. So well over a calendar month, right? The QLD ETF, which is the 2 times NASDAQ, the average hold there is 18 days. So if you're noticing a pattern here, Nina, it's the fact that the more volatile the underlying asset is, the shorter the holding period is. But at the end of the day, you have to remember that FINRA and the SEC make it very clear, or make the issuers make it very clear, that these daily products are meant to be used for a day and a day only. That's not what the data shows, though, right? And that's kind of the impetus why we came up with this new suite of products here at Tradr.
So why did it take 18 years to bring such products to the market when the problem was known and the SEC has warned about the dangers of leverage products so many times? So why do you think no one else tried to launch such products before? And it's good that you have come up with these innovative solutions, but why it took such a long time?
Yeah, I have a couple of theories on this. The first is that these products, the daily leverage products, they still solve a problem for investors, and that's they do make it easier and more cost efficient to use leverage versus doing it on your own. You don't have to worry about getting a margin call. You sort of, your upside or downside risk most of the time. And you're not paying your brokerage platform 7 to 8% to employ leverage. So there's a bit of, let's call it convenience associated with these 200 plus daily products. The second is old habits die hard, right? As you mentioned, these products have been around for 18 years and they've grown immensely in popularity and in assets. And, investors around the world are using them. Investors who are not allowed outside the US to even use leverage in their accounts. So they find it as a way to amplify their own view, their own conviction when it is a high conviction on a stock, or let's say, or an index. So it's the path of least resistance for those investors as well. So, that's kind of from a use case, the train's gotten rolling, very tough to slow down. From a business case, if you think about the 2 largest issuers of leverage ETFs, there's $100 billion in this industry. So why would you necessarily introduce maybe a smarter long-term solution for investors to use leverage if you already have a wildly successful franchise based off of daily strategies, right? And I do know that Direction several years ago did try to launch ETFs that had a reset outside of a day, but they weren't able to get that through. And I believe they pivoted to launching some mutual funds. So again, for those three reasons, I mean, I feel, that's probably covers kind of anything you can kind of come up with as to, why there hasn't been anything until we did it recently to enter the space in terms of a new way to look at leverage.
So you have launched 12 such products now. And could you walk us through this suite? Because I see products, 2X products that track popular ETFs like SPY and QQQ and SOX and ARKK. And then there are some single stock ETFs as well that track NVIDIA and Tesla. So please tell us more about these ETFs.
Sure. So before we launched the Calander Reset ETFs, Tradr actually manages still 4 daily reset ETFs. And we were the first ETF issuer to bring single stock ETFs to market in July of 2022. And 2 of those names are TSLQ, that's our 2x short Tesla ETF, and NVDS, that's our 1.5 times short daily NVIDIA ETF. And the other 2, as you mentioned, are 2X long and short on the popular disruptive innovation ETF, ARKK. TARK, TARK is the long, and then SARK is 2X on the short side. So we did have experience, and we do have experience for several years managing daily reset products. And part of the impetus, in launching this totally new revolutionary suite of calendar resets was we were getting feedback from investors, especially in our TSLQ product. Oh, I bought your TSLQ product 7 months ago. Over that time, Tesla is down X percent, and your ETF was only up, 2%, something like that. So it was pretty clear to us, anecdotally, that investors in our own funds were not using these products as they were meant to be used. And this isn't only from self-directed or retail investors. We were getting emails from advisors on this. And so it's pretty clear to us that there was a really strong need to build a product, Nina, where your return outcome met expectations. And, so that's when we embarked in filing for this new suite of products. We've gone effective on 47 ETFs, calendar reset ETFs. We've launched 12 of the 47. And as you mentioned, we have a mini suite on SPY. So we have a weekly, monthly, quarterly, all 2X on SPY. We have a weekly, monthly, quarterly, all 2X on QQQ. We have a weekly and monthly 2X SOX, SOXX, that's the iShares Semiconductor ETF. We have a monthly and a quarterly on TLT, that's the iShares Long Bond product. So the monthly is 2 times and the quarterly is 1.75 times. And then we have weekly calendar resets for NVIDIA, that's 1.75 times long. And then Tesla weekly, that's TSLW, 1.5 times long. As you get into the single stocks, it's a little harder from that concept we just discussed earlier on the volatility decay to not only attain a higher leverage ratio, but stretch it out over a longer period of time, because the chances of, let's say if we had a quarterly NVIDIA ETF 2 times, there's a really strong chance that NVIDIA may see a sizable drawdown over the course of that quarter, right? Which would put the fund in jeopardy because that leverage floats during the quarter. So from that perspective, we wanted to stick with shorter periods for the single stock names.
Excellent. So these are weekly and monthly and quarterly reset ETFs. And my understanding is that generally you get the stated leverage if you buy at the start of the calendar period and hold it till the end of that calendar period. So what happens if investors say buy or sell during the week or month or the quarter? And also what happens if investors hold for a longer time? So for example, if they hold a weekly reset ETF for say a month or a quarterly ETF for a year, what kind of outcome they can expect?
Sure. So I do want to acknowledge that you are correct. If you buy our MQQQ, which is 2 times long, the QQQ ETF, if you buy that on the last day of the quarter and you held it of the month rather, and you held it for the month, you would expect to get 2 times or 200% the return of the Qs for that month. You, like any ETF, of course, you can buy it intra-month. You can hold it for 1 month or many months. But the fund is designed to give you, again, 2 times the return of the Qs for that calendar month. There's nothing, as I said, holding you back from holding it longer, but the actual leverage you may receive, Nina, will most likely be different than 2 times. Now, we do have on our website, I'd like to point this out, for each fund page, we have something called estimated exposure level. So for instance, for MQQQ, for as of the close yesterday, November 7th, MQQQ leverage was 189% because the Qs have gone up during the month. So if you bought it now, you're going to, and held it to the end of the month, you'll receive under 2 times, again, assuming you sold it the last trading day of the month. And that's when we do that reset in the last calendar trading day of the week, the month, or the quarter. But every day, as I mentioned, you'll be able to see what the estimated exposure is and whether that if you bought it at the close on that day, the leverage that you would expect to receive if you held it until the end of the month for MQQQ, for instance.
So who are these ETFs for, and who are the current users? And could you talk a little bit about some of the use cases that you think are the best for these kind of products? Are they supposed to be used as short-term trading tools by high conviction traders, or investors, active investors can also use these products, or these can be used by advisors as well?
So the shorter answer is just about any investor, we believe, can make use of our calendar reset ETFs. And that goes for a retail or self-directed trader who may have some ETFs that they trade in their Robinhood account, all the way up to an RIA or a TAMP that may run models, especially on a tactical basis, where they understand the perils of holding daily levered products for longer than a day. And that risk is something that they kind of don't want to deal with. We've seen some really good pickup from some independent advisors and RIAs since we launched the products over 2 months ago, who are more tactical in nature, and they don't want to have to deal with that volatility drag that the daily products are experiencing. A lot of times you will have an RIA that has a model and they want to keep that model allocated to certain asset classes or certain exposures over the course of a month or a quarter. Those allocations, when you're using the 2x or 3x leverage funds, can really knock those equity or bond allocations way out of whack. So at least with our calendar resets, you know that at the end of the quarter, for instance, that if you invested in QQQP on the last trading day of the quarter and held it to the last trading day of the following quarter, you're going to get 2 times gross of fees, the performance of QQQQ. So it introduces sort of a level of, I don't want to say certainty, Nina, but maybe visibility into how the portfolio is kind of balanced or out of balanced every single day, what that construction of that portfolio is. And it allows you, I don't want to say to monitor it less frequently, right? But at the end of the day, because you're not experiencing that reset every single day, a lot of your exposures by holdings in the portfolio aren't going to get out of whack with what your sort of goals are. And again, this happens to retail traders as well. Most retail investors, if you're not a professional day trader, let's say, they don't have time to look at their portfolio every single day. So I'm not suggesting that if you bought MQQQ, it's to set it and forget it, but you're not wearing that volatility of TQQQ or QLD, for instance, every single day. And you can feel a little bit more comfortable about what that path is going to look like if you held it over the course of that calendar month. So again, just about any type of investor would have an interest in these. And the fact that your leverage, as I said, floats throughout during the period, you're not going to get a margin call if you're a retail investor, right? Let's say the Qs go down and you own MQQQ, you're not going to get a margin call saying, all right, you got to cover this margin call, right? So you can know with confidence, if you have a certain degree of confidence that, the Qs are going to bounce back, over the next 2 weeks or the last 2 weeks of the month, it's not affecting your capital position, right? I think you had asked how people could use it. A lot of traders swing traders in particular, they really like looking at seasonality, right? So when do certain asset classes, certain stocks, certain indexes, when do they perform or underperform the best, right? Throughout the calendar year. So for instance, December and November are seasonally very strong months for US equities, including the S&P and the NASDAQ 100. And if you have a bunch of conviction that, listen, from now, the election's out of the way, we're expecting one more rate cut, maybe, looking like we're going to get a soft landing here. Don't expect much volatility from now until the end of the year. And you have that really strong conviction that US equities are going to have a great rest of the 2024. Then using leverage to express that view could be a smart way to do it, again, and also more capital efficient than using leverage in your brokerage account. So really no shortage to the type of investor that we feel can use our calendar reset ETFs.
Excellent. So what's next for trader ETFs? How many more of these calendar reset ETFs can we expect in the coming months?
Yeah, well, as I mentioned, we went effective on 47 funds and launched 12 of them. There are some exposures still, I think, that we might, based on feedback that we've gotten so far in the market, that we might want to focus on next, particularly on the inverse side. Inverse ETFs are a bit of a different beast, especially when they're leveraged. The market, especially the past 2 years, as we've been in this really strong bull market, has trended right from the lower left to the upper right. Real strong uptrend. If you held an inverse ETF over that, a daily inverse ETF over that time frame, you're really going to feel the effect of that volatility decay. The compounding as things keep going up and you're in a consistently short, daily levered ETF could really, really hurt you if you're holding that position. So we do have several short leverage ETFs that we want effective on, including on SPY and Qs, weekly, monthly, and quarterly, as well as on the SOX ETF as well, weekly, monthly, and quarterly. So those are good candidates. We also do have IWM, which is the small cap iShares product. We have a weekly, monthly, and quarterly. We went effective on those three. So those are good candidates, especially given the backdrop of the administration change and what people are right now, I'd say maybe a little bit more bullish on small caps than they were a couple of weeks ago. And we also have several sector spiders, weekly, monthly, and quarterly, in the queue that are in the prospectus that could be interesting. So a lot of it depends on market conditions, but if you kind of wanted to play the broader market, I'd say IWM and a couple of the inverse ETFs, along with FXI, which is the iShares China ETF. We do have 2 long FXI products that have been declared effective. 3 rather, weekly, monthly, and quarterly. So China has been a really interesting trade. On the long side, of course, the past couple months, the jury's still out as to how things are kind of going to end up there, given this administration's view on Chinese imports and potential tariff situation and all the other problems going on internally in China. But our levered FXI products could also be interesting candidates. But we also want to show, Nina, that the products that are out there now, the 12 of them, work like they're supposed to, and investors can look at these products and say, oh, wow, look, I actually got what I thought I was going to get in terms of the leverage when I held it over that certain period. So there's a element of confidence that we'd like to have investors instilled in the current set of products before we go and launch a bunch of others.
So switching gears a little bit, I wanted to talk about the role of leveraged ETFs in exacerbating the stock market volatility. So we keep hearing about this every now and then, particularly when markets are very volatile. And that happened in August this year. And again, some market experts warn that these leveraged ETFs are exacerbating the market volatility because of the daily rebalancing at the end of the day. So I was interested in your thoughts.
So, as you know, I've been in the world of ETFs for over 15 years, and this is a great debate, although I don't personally think there's really any debate to be had about the role that ETFs in general play in generating volatility in the market. That's a bit of a blanket statement at the end of the day, and for a couple of reasons. The first is there are several widely popular and large inverse or short ETFs. So while you do have the longs moving and being actively wildly traded, on the long side, there are short ETFs, right, which take the opposite positions of, say, for instance, the TQQQ, right? SQQQ is the short version of the triple Qs, right? That ETF is an $11 billion ETF by itself that trades almost 40 million shares a day, over $1 billion a day on the short side. So how does one reconcile the activity on the short part of the ledger with the long side? If you think about it, it helps to dampen the volatility because you have investors that have a long bias and you investors that have a short bias, depending on the day. So ETFs are often an easy scapegoat, Nina. You've been doing this a while and you've spoken to, at this point, probably hundreds of issuers, and nobody can really quantify or pin down a level or pin ETFs down to increasing any sort of volatility because it's, in my mind and the work that I've always seen, it's sort of causation at the end of the day, right? Just because you're seeing volatility heighten when things sell off and you're seeing ETFs grow in popularity, that doesn't mean that ETFs are responsible for it. Think about what happened on the day after Election Day when volatility got sold off massively, right? The VIX got crushed. You saw a ton of ETF volume, ton of assets. We're on pace this year, right, for record ETF inflows. yet we've seen a decrease in volatility as measured by the VIX. So that's something that I really, yes, it spikes. That we saw a massive VIX spike, right, in August. And let's see, right now, year to date, we're not necessarily, we're up a little bit on vol, point to point. But overall, if you look kind of past 5 years, right, we're down point to point, while ETF assets have soared. So how can you say, these experts or whatever people want to call them, that ETFs contribute to volatility when we've seen a decrease in volatility, as measured by the VIX anyway, over the past 4 to 5 years? So that's where I have a little bit harder time sort of accepting that at face value.
I agree with you. ETFs get blamed for no reason. And in fact, I have seen some good research that shows that the impact from these levered ETFs on a day-to-day basis is usually not noticeable. And only on days if the market is very illiquid for some reason, and for some reason there is a very sharp move at the end of the day, then probably there can be a little impact. We'll have to leave it there, Matt, but thank you so much for joining us today, and congratulations on the successful launch. These are very useful products that are trying to address a well-documented issue, and also good luck on the upcoming launches.
Thanks for having me on, Nina. Great to talk to you.
That was Matt Markiewicz of Tradr ETFs, and he talked about his Tradr 2X Triple Q monthly ETF MQQQ. And if you want to learn about this ETF and other Tradr ETFs, please visit tradretfs.com. And we also briefly discussed the ProShares Ultra Pro QQQ ETF. The ticker symbol is TQQQ. And we talked about the Greenwich Shares 2X Long NVIDIA Daily ETF. The ticker symbol is NVDL. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.